Welcome to the video. Today we will uncover the hidden cost of delegation in investing and how a seemingly small 1% fee can quietly drain thousands of dollars from your future. We will also show you simple, hands-off strategies that reduce fees and capture market returns with minimal effort. As we move forward, we will start with an important disclaimer and then go into the agenda. Before we begin, please note this content is educational and not financial advice. Markets involve risk, and past performance does not guarantee future results. You should consider your personal situation and, if needed, consult a qualified fiduciary financial advisor. With that in mind, let's move on to today's agenda. In this agenda, we will cover why fees matter, reveal the performance trap compared to simple index funds, and present two minimalist strategies: target date funds and broad index funds. Then, we will outline an actionable 5-step switching plan, visualize the concepts with diagrams, and finish with quick quizzes and a concise summary. Next, let's outline why fees can be so destructive over time. A 1% annual fee on $60,000 is $600 per year. That may not sound like much, but compounded over decades, fees scale dramatically. The problem intensifies if your managed portfolio underperforms simple index funds. In other words, you may be paying more for returns that are actually worse, With this context, we will explore the performance trap next. Many managed portfolios report returns around 11%. However, broad market index funds have, in numerous recent 6-year spans, delivered 14 to 17%. If you pay a 1% fee on top of that, the gap widens further. The pie diagram illustrates an example year with a 10% gross return reduced by a 1% advisory fee to a 9% net. Over many years, that difference compounds to a large shortfall. This is the essence of the performance trap: paying a premium for inferior or average results when inexpensive index exposure exists. Next, we will visualize how money flows from your contributions through fees and into net returns. This flowchart shows contributions entering your portfolio. From there, a portion is siphoned off as fees, while the rest continues as net returns toward your future balance. The higher the fee, the larger the fraction that leaks out before compounding can work in your favor. Over decades, even small differences in net return rates lead to dramatically different outcomes. Coming up, we will quantify this with a side-by-side table. This table provides illustrative estimates. First, with a similar market environment over 30 years, a portfolio with a near 0.05% fee can grow roughly to around $1,035,000, while the same portfolio with a 1% fee might grow to approximately $796,000. That is a difference on the order of a couple $100,000, driven purely by fees. Second, over 6 years, a $60,000 investment might reach roughly $112,000 at 11% versus about $139,000 at 15%, highlighting the impact of underperformance relative to a broad index. These are rough, illustrative numbers, not guarantees. Now let's pivot to simple ways to capture market returns cheaply. There are two extremely simple paths. First, target date funds use your target retirement year and adjust the asset mix automatically, handling diversification and rebalancing at low cost. Second, broad index funds and EFs provide total market exposure with minimal fees. Automating regular purchases helps you stay disciplined and ignore short-term volatility. The key is keeping costs low and remaining consistent. Next, we will compare when a TDF might be better than a single index fund and vice versa. Target date funds offer maximum convenience, with automated diversification, rebalancing, and a glide path that reduces risk as you approach retirement. They are slightly more expensive than a single broad index but remain very low cost. A single broad index fund often has the absolute lowest fee and captures the market effectively, but you might need to introduce bonds later and manage rebalancing yourself. The choice depends on your preference for simplicity versus control. Next, we will provide a clear, step-by-step switch plan. To switch, first choose a low-cost brokerage without account fees. Next, decide whether a single target date fund or a single broad market index meets your simplicity needs. Then set up automatic contributions. Consider consolidating high-fee accounts to simplify management and reduce costs. Finally, commit to your plan and avoid short-term decision-making. Coming up, we will visualize how compounding fee drag grows over time. This timeline highlights how the fee gap widens with time. Early on, the difference may appear small, but by years 10, 20, and 30, the cumulative shortfall becomes substantial. Because compounding amplifies small annual differences, fee drag grows nonlinearly. This visualization reinforces why minimizing fees early and consistently is crucial. Now, let's test your understanding with a quick quiz. Question: which ongoing cost is most likely to erode long-term returns the most? Options are 1% AUM advisory fee, 0.50% index fund expense ratio, 0.05% index fund expense ratio, and a one-time $50 account opening fee. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the 1% AUM advisory fee. An ongoing percentage fee that compounds annually is far more damaging over the long run than a very low expense ratio or a one-time fee. Next, let's try one more quick question about simplicity and suitability. Question: if you want maximum simplicity with automatic rebalancing and a built-in glide path, which option fits best? The options are: pick individual stocks, use a target date retirement fund, trade sector ETFs monthly, and buy a broad index fund and rebalance daily. You may pause the video now to consider the answer. We will discuss the answer in the next section. The correct answer is using a target date retirement fund. These funds are built to be set-it-and-forget-it solutions with automatic rebalancing and a glide path that adjusts risk as you age. Next, let's recap the key takeaways before closing. These are the main points. First, fees compound against you and should be minimized. Second, many investors pay more for underperformance, so avoid the performance trap. Third, capture market returns cheaply using target date funds or broad index funds. Fourth, automate contributions and ignore short-term noise. Finally, every reduction in fees supports your long-term financial security. Now let's summarize the story and close out. In summary, a 1% advisory fee equates to $600 per year on $60,000 and compounds against you. Low-cost index funds have historically often outperformed many higher-fee managed portfolios over multi-year periods. Using a target date fund or a single broad index fund provides hands-off simplicity at minimal cost. Switching is straightforward. Choose your approach, automate contributions, consolidate where appropriate, and remain disciplined. Finally, let's wrap up with a quick thank you and a call to action. Thank you for watching. If you found this helpful, please like the video, share it with someone who is paying unnecessary fees, and subscribe for more straightforward, low-cost investing content. In the comments, tell us your plan. Will you choose a target date fund or a single broad market index, and why? Until next time, keep your costs low and your strategy simple.